Hi and welcome to this second lesson of the video course. In this lesson, we'll look at long-term and short-term investing. First, we'll try to narrow down what the terms mean, then I'll answer some questions for which I'll compare long-term and short-term investing, and in the end, I'll draw a conclusion about which is best. So what does long-term investing mean? Well, there isn't really one way to define it, but for the purpose of the course, we'll use the thumb rule that long-term investing is usually longer than 3 years. Having said that long-term investing is anything above 3 years, we can now say that short-term investing is anything below 3 years. So that can range from a few seconds, or less than a second, up to 3 years. Now you may have a few questions, such as, can one really invest over less than a second or a few seconds? Yes, they can. That is called high-speed trading. That's what firms on Wall Street do, or other firms, when they have loads of money to invest in technology. They invest in technology so they have faster computers. And I've drawn a simple graph right there. And that means that the signal from the market, the computer processing it and the computer sending a signal back from a normal computer is on average T1. Same thing with a faster computer is T2, and approximately T1 minus T2 is 0.02 seconds. So the computers from the Wall Street firms are very slightly faster. But what happens within those 0.02 seconds is I've drawn a graph here. So the Wall Street firm learns that the market is rising. So they buy right there, Wall Street. It could be any other firm, but let's take Wall Street. Now, usually when something rises, people buy it, and so the resources become more scarce, and so the price rises even more. That's how it works until somebody sells out, and then the price starts sinking. So then, that's Wall Street who buys in, that's normal people who buy in. Normal. And as you can see, there's the price difference, and they've bought it there, and they've bought it there. So that's the difference, and then they can wait either and sell it out right then, they already make loads of profit, or they can wait to sell it out right then. But what that means is they can use very small time differences to gain an advantage. Now another question you might have is, what if I invest over 2 years and 360 days? Does that still count as short-term investing? Well, the answer is really, it depends, because those, as I mentioned before, are thumb rules. And that means that they're not definite. What matters the most is your mindset when you do a trade. So imagine you bought a stock 2 months ago, but now you see another company you think is going to last greatly for 10 years. What do? You sell out on the stock you bought a few months ago, and you buy that stock you think is going to last greatly. And that's definitely a long-term view because you do it to get sustained return. And that's what really matters, your mindset. The third and last question I'll address is, why invest over the long term if I can make quick revenue over the short term? Well, to answer that question, I'll have to compare long-term and short-term investing, and so keep that in mind while I do the comparison. Now let's compare long-term and short-term investing. To visualize it, I've drawn a quick table. So, long-term, short-term, and I've written long-term cancels out effects of a fat tail event. Now, what is a fat tail event? So you have your graph, and then it's going along steadily, then suddenly you have a sudden peak. So that is what is called a fat tail event. Now remember, a fat tail event could also go the other way, it could go down a bit. So what does that mean? It cancels out the effects of a fat tail event. Well, if you invest over the short term, and you're lucky or unlucky, you invest over that period of time, that is going to affect your investment greatly. Whereas if you do it over a longer period, if you take all of that into account, and you average all of that out, that fat tail event is going to be much less significant. And that's what is meant by more predictable and less predictable. And now, what do I mean by usually safer and usually less safe? Well, that is kind of has to do with fat tail events, but also with something else. Now, over the short term, if you want to make loads of money, you will have to buy at that point and sell at that point. Wait, let me get the red pen. you have to buy at that point and sell at that point. Now that means that if you want to have a big difference between those 2 points, you need a volatile investment, an investment that moves along a lot, whereas a less volatile investment would be something like that. Now, more volatile investments usually are a bit less safe, but we'll look at why in another video. For now, just remember that. And so that means that short term is usually less safe. Now, why is long term more safe? Because over the long term, if a curve goes along like that, or it goes along like that, doesn't really make much of a difference for you as long as you get that difference from there to there. Now you get it from there to there, but that's basically the same, and especially the ups and downs cancel each other out much more during the long term. Now, based on the comparison I've just drawn, I can quite easily answer the third question, why invest over the long term if you can invest over the short term and make quick money? So, of course, you can make quick money over the short term. You can buy there, sell out there. But as you can see, those ups and downs are basically equally distributed. And there's no guarantee that that would just go down at that point. So basically, with that short-term graph, it's almost a 50-50 chance of it going up or down. And then you might as well go to the casino, put all your money on red at the roulette table and just pray to dear God you make money. Whereas over the long term, as you can see, normally it rises steadily upwards, even though there's downs, that's normal. But over the long term, it turns more into a 90-10 chance, where the 90 is that it goes up and the 10 is that it goes down. Because the 10% are usually either the company is completely disgraced, and so they lose all their stock value, or they go bust, or there's a giant market crash and you have to sell out during that market crash. But those are slightly, or more than slightly, smaller chances than 50% of it going down. To visualize what I've just told you about, I've drawn the last 30 years of the S&P 500 index, as you can see there. Now, an index is just a collection of, in this case, stocks that somebody has assembled, and that somebody is S&P, Standard & Poor's. Now, Standard & Poor's is a rating agency in America. It's very famous, and the S&P 500 is even more famous. Now, this index is usually used to represent America's market, and that's why I've used it, in addition that it is only made of stocks. Now, as we can see, there's 2 fat tail events right there. That's the dot-com bubble, and that's the subprime bubble. Now, both of those were obviously market crashes, but if you'd invested over less than 3 years, which is our short-term thumb rule, you could have seen that there's loads of moments, that's basically 3 years, invested there, invested there. There's all those ranges of moments where you could have invested and lost plenty of money over those different ranges. Now, if you'd invested over the long term though, more than 3 years, let's assume 6 or more years, then you could have not lost any money. Now, obviously I've looked it up and it's 6 years. If you'd invested over 6 years, at the worst possible point right there, or right there, you would have made your money back at one point, either there or for there. If you'd invested there, you would have made back your money there. Now, that's just to show that the long term usually cancels out those fat tail events. Now, obviously, I won't get into inflation yet, which could have eaten up your returns, but up until then, just remember that long term cancels out, weighs out fat tail events much more. So what's the conclusion? Well, as we've seen, short-term investing is basically gambling on a 50-50 chance. Now, as we've learned in the first lesson, that's called speculating. And it's okay to speculate with a little bit of money on the side just for fun. But if you want to make serious returns, sustained returns, then you should go for long-term investing, because that won't guarantee returns, but it will raise your chances of making sustained returns significantly. Thank you for watching this lesson all the way to the end. I'd appreciate it if you shared it with anyone who you think would benefit from it or would be interested in it, and see you very soon in the third video.